how much money is required, and what is the primary goal and other things. Okay, before we get started, as usual, our session disclaimer: this session is for education purpose only. Please consult professional advisor before taking any investment decision. So we started with foundation, where we discussed about the ultimate financial goals, and why we are accumulating money, and what is the purpose and everything. And also we discussed about the different assets like equity, debt, real estate, commodities. And in the last session, we discussed about passive income generation. Okay, how we can generate passive income, and what is the use of passive income, and different sources of generating a passive income. Okay. We also discussed about different no, professions available as a part-time or as a freelancer, where we can earn extra amount of money. And also we touched upon different asset class like equity, debt, gold, commodities, and how we can use each of these assets to generate a passive income. So coming back to the today's session, today we are going to discuss on equity as an asset class. Okay, we'll start with the equity. At least there will be some two or three different sessions will be there on exclusively on equity. So, first of all, what do you mean by equity? Can I see some answers? What do you understand by equity? Can I see some answers in the chat box? What do you mean by equity? And also, where equity is born, how it is grown, how it is multiplied, and how it will help both company as well as investors. And finally, we'll also see different ways to invest in equity. Okay. First, we'll start with equity. In general language, normal term, if I say equity, it just means fairness, treating equal, everyone as an equal. Okay. In terms of company, uh, it's a equal parts owned by shareholders. So suppose let's say there are four owners in the company, and if they have equal share, everybody will have 25% of equity. That is what equity means. So equity is nothing but ownership in the company. So it may be four shareholders, or it may be 100 shareholders, or it may be 1,000 shareholders. They will own the percentage of amount what they invested, will own that much of ownership. Okay. Now let's see how equity is born. Okay. This Raju, who is running a Kirana shop. Okay. Normally, Kirana shop is run by owner. It's called a proprietorship company. Okay. He's running a shop and he's doing well. Lucky. He's having good customers, and he's able to sell some goods, and he's able to make some money. He's able to make some profit. All those things are going on. Okay. Now, what happens? Raju has a Ramu. Raju has a friend by name Ramu. Ramu comes and discusses with Raju over the cup of coffee. He says, "How long you are doing a business?" He says, Raju says, "It's been a long time. Maybe it's been more than 5 years or 10 years. I'm doing this business." Then Ramu says, "I think the Kirana shop is an old traditional business. Why don't we convert this into a retail shop?" Ramu gives some idea to Raju. Raju has some funds, and Ramu also invests some money. Let's say Raju has around 1 crore, and Ramu also brings onto the table another 1 crore. They both put together, they add 2 crores and opens a retail shop. Okay, now proprietorship is turned into partnership firm. Okay, now this is also doing good. The retail shop, whatever they opened, it is doing. Customers are coming. Customers are using their card, and they're buying goods, and it's getting Then they open up a few more shops in the city, maybe different areas. Okay. Five, six branches are opened and all of them are doing good. Okay. Now, one person, like, no, both a common friend of Raju and Ramu comes to both of them and tell them, you people are doing good. Your, shop is getting noticed everywhere. Okay. People are, buying goods and your brand is getting built. Why don't you, expand this to across the city or across the state or across the country itself? Then what will happen? What they need, both Raju and Ramu now, to expand the business across the city or across what they need? Can somebody says answer in the chat box? Kavya, please allow the participants. Huh? Few people are joining in.
हाँ sir, doing.
Okay, they need more partners. Very good. They need capital. They need four funds. Yes, I'm getting some very good answers. Okay. Now, Raju and Ramu, they are planning to open multiple stores across the country. Okay. They need more resources. Okay. They need more capital, more manpower, more logistics, as well as value chain, everything they require. And they have two options. One, either they can raise the money through debt, that is in the form of loans, approaching a bank or financial institution, or they can use the route of equity. Normally, people when they start business, they approach a bank for loans. Okay, and they take a loan and they start business. And once the company starts earning, they'll repay the loan. But there's always one more way when you need more funds, and since they are very their brand is famous and they want more money, then they can raise the money through equity. Let's say that they need around 100 crores. They can use the equity option and they can call all the shareholders. They can issue shares to the equal to the amount of money everybody is putting. Let's say someone is investing 10,000, someone is investing 10 lakhs, or someone is investing 1 crore, equal to that amount, that much of shares. Let's say they're for that 100 crores, let's say they're giving 10 lakh shares. Okay. So equally, they'll divide that many shares they're going to allocate to the people who are investing money. This is how equity is born. Then the partnership firm is converted into private limited to raise the equity. There will be more partners. Then once the company start building, then the company will be converted into a limited company, and later it will get listed as an through IPO. It will get listing, and then it will be listed onto the secondary market. Okay, this is how the equity is created. Equity stocks are created. There are different stages one can invest in equity. Many people they
Yeah.
know only through once they open a demat account, they
Okay.
know how to buy stocks and how to sell stocks. But there are different ways in which one can invest. One is that's called pre-IPO, unlisted stock. So people can become investors even before it gets into IPO. So that is called unlisted stock and before listing. The second stage is during the IPO period. Normally, when company is getting listed, they will open a subscription. People can apply for IPO. They might get a slot. They may not get, but they can apply. If they get, then also they can participate in the equity. Either they can hold it or they can sell it, make a profit or loss depending on the stock price. Then also after that, once the IPO is over and stock get listed on the market, that time also they can buy. These are the different ways in which one can invest in equity. Okay. Now we'll see quickly what are the advantages of investing in equity. So for this, I would request we today we have a guest speaker with us, uh, Mr. Ankush Chaudhary sir. He is head of equity in prudent broking wealth management. He has got more than 20 years of experience in broking and wealth management. His core philosophies: portfolio diversification, risk management, and research capability. So with this, I will hand it over to Ankushar. Ankushar, please.
Thank you.
Take.
Thank you, Vikramji, and thank you to all the participants who have joined today. And this is